This market doesn't move on fundamentals anymore. It moves on fear. One tweet paused tariffs, and the Nasdaq had its best day since 2001. Then it collapsed the next day. Then it rallied again. That's not bullish. That's broken in 3 trading sessions. We watched the entire market whiplash through 10 trillion in movement, based on nothing but headlines. Meanwhile, bond yields are exploding, gold is screaming, and not a single CEO in the financial sector is willing to give forward guidance, and people aren't celebrating. They're confused, they're scared, and they're reacting to noise because they don't know what else to do. This video isn't about emotions, it's about execution. If you want to see how serious investors are navigating this chaos, this is for you. No fluff, no hype, just the truth. And a strategy that works when the market's faking everybody else out. The market rallied again on Friday, not because anything improved, but because panic paused for a second, and that's all it takes to send this market flying. This isn't momentum, it's whiplash. Traders aren't buying strength, they're front-running relief. Every uptick is based on the assumption that the chaos might slow down. Not that anything's fixed, and that should terrify you, because this is exactly how people get caught leaning the wrong way. They chase green candles without asking what's underneath them, and what's underneath this rally. Is a bond market still flashing stress, inflation expectations breaking out, and the dollar getting dumped as confidence in the US leadership evaporates? That's not bullish. That's a system shaking itself apart in real time, so if you're asking what now, here's the answer. Don't react. Reposition. This is where smart investors stop caring about headlines and start tracking behavior. What's gold doing? What are bonds doing? What are yields telling you about liquidity? If you're not watching those signals, you're already late. You don't need to predict the next move. You need to understand the environment you're in. This is a market driven by confusion. That means your edge isn't speed. It's clarity. Let others chase momentum. You focus on conviction. Hold the plays you believe in, tighten up the ones that are weak. Raise cash where needed, but don't get lured into this bounce thinking we're out of the woods. This is not a breakout, it's a breather, and when it fades, and it will. You don't want to be left overexposed, chasing the tail end of someone else's emotional trade last week on paper. The banks absolutely crushed it. JP Morgan beat Morgan Stanley, beat Wells Fargo, beat the headlines, looked bullish. But the tone behind them told a completely different story. Not a single one of those CEOs gave positive guidance, not one. Instead, they used words like uncertainty, deteriorating, tightening, and stress. That's not forward momentum, that's damage control. Let's be honest. The reason these earnings look good is because the expectations were low. That's it, we're grading against a curve set by fear, and when that curve shifts even slightly, everyone cheers like the economy's back. It's not, these banks aren't confused. They see what's coming. They see defaults rising. They see consumers slowing. They see what tighter credit, higher yields, and collapsing liquidity mean for small business and retail borrowers. And they're not optimistic. They're cautious, strategic, and measured. So while the retail crowd was busy chasing bank stocks on the headlines, institutional capital was listening to the earnings calls, and the message was clear. Stay defensive, stay liquid, be ready. Here's what matters when CEOs of the biggest financial institutions in the world are this vague, this quiet, and this non-committal about the future. It's not because they don't know, it's because they do. This is how serious players signal without spooking the herd. If you're still reading earnings beats like they mean the storm has passed, you're missing it. The storm is just beginning, and the people with the most visibility are already preparing. Now is not the time to chase. Now is the time to tighten your edge. And listen when the pros go silent. Most people think the markets turn slowly. They don't. They snap. And the snap always comes right after a moment like this, when things feel calm enough to stop thinking. That's what last week was. First, a tweet paused tariffs, then banks beat earnings, then bond yields pulled back slightly. And suddenly the crowd was back in risk-on mode. Like none of this ever happened. That's not strength, that's bait. You've got inflation expectations spiking to the highest levels since 1981. You've got the US dollar getting dumped across the board. You've got gold breaking out and bonds selling off fast. That's not a recovery environment, that's capital flight in slow motion. And the biggest tell, China just hit back with a 125% tariff wall. That's not negotiation, that's escalation. We're not walking towards resolution, we're walking into an economic knife fight. So if you think this bounce means safety, you've already lost because it's not a bottom, it's a setup. Bear markets don't end when headlines get quiet. They end when credit markets stabilize, when macro pressure cools, when global liquidity returns. None of that has happened. What we have is a market gaslighting itself with every green candle, and most people can't tell the difference between relief and resolution. Here's the truth. This is what a trap looks like. It looks bullish, it looks exciting. It rewards bad habits and punishes discipline. Then it turns and takes back twice as much. We've seen it before. 2001, 2008, 2020. Every time the market breaks, it bounces hard before it bleeds slow. If you're serious about winning, don't mistake silence for safety. This setup is loud, and it's not done yet, while most people were panic selling or chasing the bounce. I did nothing. I held not because I was scared, but because I was already where I needed to be. I didn't need to scramble. I didn't need to second guess because my positioning wasn't based on news. It was built on conviction. Here's some of my major positions. NVIDIA, Palantir, SCHG, the triple QM, and JPQ. These aren't guesses, these are deliberate. I'm not trying to win the lottery. I'm building exposure to trends I believe in, and income streams that offset volatility growth plus protection. That's how you stay in the game. And no, I didn't write any covered calls last week or this week because in a market like this, capping upside is a fast way to miss your own breakout when volatility is this high. Assignments can cost you the entire move. Here's where I am right now. I'm up a little year to date. That could change tomorrow, I know that. But here's the difference. Most people aren't up at all. They're red or worse. They're frozen because they're not thinking long term. They're reacting trade to trade with no system. I didn't flinch because I wasn't guessing. I had clarity when things dropped. I stayed in when they bounced. I didn't chase. And that's not luck. That's strategy. Discipline doesn't mean doing nothing. It means doing only what matters. It means filtering out the noise back in the plays you trust and knowing when to just sit still and let others self-destruct. If your account lives and dies by the latest headline, you're not investing, you're gambling. And in this market, gamblers are getting crushed. Most investors aren't losing because they picked bad stocks. They're losing because they're thinking like amateurs in a market that punishes hesitation right now. I'm up a little year to date, and that could change tomorrow. That's the game. But the reason I'm still standing while others are drowning is simple. I've got a framework. I'm not making decisions in reaction to price. I'm making them in response to risk. That's the difference. Most people are looking at candles. I'm watching capital flows. They're zoomed into intraday volatility. I'm tracking macro pressure, liquidity, and rate movements. One approach keeps you calm. The other keeps you broke. The market isn't rewarding fast fingers right now. It's rewarding clarity. And clarity doesn't come from headlines. It comes from preparation pros. Don't chase. They don't dump positions because something red flashes on their phone. They stay focused on position sizing. They stay focused on position sizing, good setups, and macro conditions. They don't need to be right every day. They need to be positioned when it counts. That's why most people are losing. They think they're investing, but they're really just reacting. They change their mind every time the market changes direction. And when it doesn't go their way, they blame the system instead of fixing their approach. If you want to think like a pro, stop asking what the market's going to do. Start asking what you're going to do regardless of the outcome. Because pros don't play the prediction game, they play the positioning game, and they win because they're ready while everyone else is still refreshing their feed hoping for some form of direction right now. No one thinks we're out of the woods, and they're right. This market still feels off because the bounce is real, but the uncertainty underneath it hasn't gone anywhere. That's the part most people can't quite explain, but they feel it and they should, because a rally doesn't mean resolution. It just means the pressure let up for now. Tariffs are still escalating. Inflation isn't dead. Guidance is disappearing and the global economy isn't stabilizing. It's recalibrating under stress. This isn't about being bullish or bearish. It's about being honest. We're in a market where anything can trigger the next leg up or down. One tweet, one policy shift, one earnings miss. That's not a stable environment. That's a minefield. And the smart move in a minefield isn't a sprint. It's to move carefully, deliberately, and with your head up. This is where patience pays. This is where discipline shows you don't need to predict the next move. You need to be ready for it. Mentally and strategically. Don't confuse movement with direction. Don't confuse green candles with progress. Just because we bounce doesn't mean we've turned the corner, and definitely don't rush to make up for lost ground. That's how emotional decisions creep in. Stay focused, stick to the plan, and let the market come to you right now. The edge goes to the investor who can stay calm when everyone else is twitching. No one knows exactly how this plays out, but we do know how not to blow it. Don't chase, don't flinch, and don't lose sight of what actually matters. Because when the real move comes, you'll want to be positioned, not panicked.